I just, I always worry with these things. You've got hundreds and hundreds of firms throughout the UK reinventing the wheel when you guys have probably already built it.
Yeah. No, I take that.
Fantastic stuff. So let's move on to my favorite topic. And I'm gonna put, these are various news headlines, but that I am putting together into one. So basically, last year, our dear British investor essentially fled the stock market at a record rate. So in 2025, British investors pulled a total of £6.7 billion net from the equity market. That money went into cash, fixed income products. Some went into multi-asset funds, but essentially we pulled money out of the stock market. And when you look at the month by month flow, you saw there was net inflow from equity, net outflow from equity in January, and then February, March, April was fine somehow, and then from May through to the end of the year, we were pulling near on 800 million, some month a billion net from equities. And what did the MSCI index do in 2025? 14% return. Even our forgotten, I want to say, FTSE 100 reached a new all-time high, 10,000 points. First thing in January. What the heck's going on?
Yeah. I mean, it's classic emotion-led decision-making, isn't it? And I think it just highlights the need for, advice and planning, because people will often struggle to act rationally when left to their own devices.
Yeah, no, you're 100% right. I mean, I think there's probably too much information, not enough wisdom, frankly. We're bombarded. We all are, and we can all be susceptible to it. We're bombarded by messages all the time, aren't we? That, there's going to be the next big collapse or a tech bubble burst or AI bubble burst or whatever. It's just this constant flow of, it's not even really news anymore, is it? It's just opinion that arrives on the phone, on the laptop constantly. I suspect that's a lot of what's behind it, because I'm guessing these people didn't all have fixed expenditure, fixed outgoings, plans for that cash. They're just responding to what they're hearing. Because it is insane, isn't it, to be pulling cash out of a market when the market's on an absolute tear. It is mad if you're a long-term investor. It really does worry me.
How do you, is this something that you do, evidence or demonstrate that this is one of that just invaluable value of advice? How do you say to clients, look, this is why you're paying me? How do you even quantify that to say, investment returns are lumpy. There are going to be these periods of just constant temptation, from deluge of news coming at you. But if you stay on your seat, frankly, paying me 80 basis points, 100 basis points a year is nothing compared to the money that I will save you from making these silly mistakes. Does this even come up in your conversation with clients?
Definitely. And, unfortunately, people tend to sell fear and buy confidence, and unfortunately in that order, don't they? But it's absolutely the conversations I have with clients when we very first take them on as clients. It'd be really interesting, and the stat probably exists somewhere, but it'd be interesting to know the people that pulled money out of the market, were they DIY investors or were they advised clients? That would be really interesting to know, because our job is more about behavioural coaching than anything else these days, and it's trying to stop people making those expensive mistakes.
Well, we don't have that level of granularity, Carla, unfortunately. I agree with you. It'd be incredible to have. What I do know is that active equity investors, the people who pay fund managers to navigate uncertainty in the market, net pulled, you sitting down, £0.9 billion from equity funds. Index investor, on the contrary, net actually added 12 billion pounds of inflow. So you saw 12 billion pounds going into active equity funds, near on 19 billion pounds of outflow from passive equity funds. The net, i.e. 6.7 million equity fund of outflow in equity fund, essentially is from the active side of things. So my point is, we don't have that level of disparity between advised and non-advised. We do have at active. Is that a way to get an active versus passive debate started? Not necessarily. I'm just looking at the numbers.
Yeah, I mean, and those flows from active solutions to passive solutions have been billions net, haven't they, for years now?
Yeah.
I remember looking at these kind of numbers a decade ago, and you had that kind of outflow from actives and an equivalent inflow into passives, and that's fantastic to see. And I'm sure that will carry on. The worrying bit is the move to cash. And to be honest, it's the bit in the middle that's getting lost through that churn. That is the worry. I mean, look, at the end of the day, all of us on this call, we are serving a small percentage of the population, and I'd like to then come in, Carla's right, I bet the platforms have some of this data, actually, particularly the ones that have got direct-to-consumer arms and advisor arms. I'd like to think that the advised portion of the population have remained invested and will remain invested until they actually physically need the money for spending it on something. But by volume, it's the majority of investors that are behaving like this, because by volume it's the majority that aren't getting advice, unfortunately. Until we can find a way of bridging that gap, and I don't know that that's arrived yet, but until we can do that, and maybe that's technology, maybe that's loosening of regulation, we can talk about that today, maybe we can start nudging a broader section of the population into staying invested and staying the course.